Have you ever wondered why compounding interest is called the eighth wonder of the world when it comes to saving money and getting a return on it, and then investing the money that you get from that return gives it the ability to compound? That's exactly what we're going to be looking at today, is why compounding interest really does contain the power that it does. Now, of course, it allows growth exponentially. This is one of the biggest things when it comes to compounding interest. When you start looking at 401k plans, when you start looking at investment strategies, when you look at the compounding effect that you can have over a multitude of years or even decades, it is kind of crazy. So assuming you put $100,000 into an investment account and it's yielding an 8% return for the next 20 years, simple straight interest, you would have $260,000 with straight interest, 8% interest paid annually. But when you put in the compounding effect, when you look at that same 20 years, that $100,000 has turned into $493,000, which is 5 times as much over 20 years. And looking at that, you just 5x the income that you had or the money that you had invested because of the compounding factor. Now, when you think of one of the biggest explanations or really true life case scenarios of this is looking at Warren Buffett. He started investing at a very young age, really built up an empire. When you started looking at him at age 65, that is where the compounding really exponentially went into millions, hundreds of millions, or even billions of dollars of compounding interest that we've seen. So clearly, compounding interest is much more lucrative than pulling the money out with simple straight interest. To really maximize the power of the compounding and supercharge your savings, you do have to remember these couple things we're going to look at. The first one being starting investing early. When we start looking at the baby boomers, they invested about 35. When you started getting into the millennials, we were about 25. And when you are starting with the Gen Zers or the 19-year-olds right now, 19 is the age that they are starting to investing. So not only are we seeing investing at a much earlier age, but that gives the ability, if you start in your 20s and you have 40 years of compounding interest until the age of 60 to retire, the additional couple compounding years before you do retire are going to exponentially really grow with that balance. Now, of course, the earlier that you start doesn't make a big difference if you're not making consistent contributions and putting money into a retirement account. So think, for instance, if you started your first job, you put in 10% of your income, and through your entire 40, 45 years that you're working, you are putting in that 10% income. It is estimated you would have $3 to $5 million for retirement, which means with a simple 10% contribution, with the compounding effect, consistently making regular contributions as your income can increase, and especially putting it into ETFs. Now, I want to give a big shout out to ETFs, the exchange traded funds. That is all that I invest in. If you've seen some of my videos, if you've seen some of the portfolios, when you start looking at long-term growth and you look at the ability for very, very low index funds, it is really recommended. Even Warren Buffett recommends investing in something like the VOO because they have typically a much lower expense ratio and allows for instant diversification across multiple industries. And if you're putting in something like the S&P 500, the VOO, the Vanguard S&P 500 ETF, you can actually invest in 80% of the market with that fund, which is kind of crazy. Now, of course, when you're making and starting investing early, then you're making your regular contributions. It is about patience. When they look at some of the largest accounts that we see for retirement, most of them are from people who are already deceased, because to reap the benefits of that compounding interest, it takes not only time, but it does take a lot of patience. When you start making those regular contributions, it is very easy to do a lot of things which really set for detrimental and can put your entire retirement at jeopardy. Some of the things that we see is people borrow against their 401k. They're taking loans across their 401k. We have seen first-time homebuyers that are borrowing money or doing withdrawals from that 401k. We see money that is taking out of retirement accounts that is not earmarked or not utilized for retirement at all. When it comes to retirement and those retirement funds, they are meant to supplement your income when it comes to Social Security. Now, we know Social Security supplements or essentially pays about 40% of your income. That means you have 60% left if you want to have the exact same quality of life that you had before. Now, of course, when most people get to retirement, they end up spending a little bit more money in retirement because they actually have the time factor that is giving back to them, meaning that you might actually see your expenses go up when you get into retirement. Now, of course, the patience to leave the money in there to look at other avenues to make those contributions is really talking about set it and forget it. When you think of that 10% contribution, and if you set 10%, that is it. You're not going to have to adjust it. You're not going to have to move it. You're not going to have to change it. Making sure that your investment is in a good place, though. And what I mean by that is make sure you know exactly where your money is being invested into. If you're in a set of funds or whatever your employer offers, that is not really cognizant for growth. That is not really growth focused. We've seen a lot of these when it comes to some of the target date funds where they don't really have a huge growth factor and the overall returns on them are far below what we see of most ETFs. So make sure, again, you know exactly what your money is going into. And the counter for this is if you're putting, and let's say your company matches 4%, if they do not have a good investment lineup, invest that 4%, get your 100% match, make sure you know the dollar for dollar, that you're not leaving money on the table. Take the other 6%, put it into M1 Finance. We have a link down below, and then you can go ahead and set it and forget it, just like we were talking about. And of course, you have to know exactly your lineup. So definitely looking for a financial advisor or someone who can guide you on that investment journey. Now, of course, without investing or with investing this money, really focusing on the rule of 72. Now, this is Sean Carpenter, chairman and CEO of Stock Alarm, what he calls the rule of 72. Just divide 72 by your yearly interest rate. Then you know how many years it's going to take to double your cash. Now, of course, you want exponential growth. The higher that you have on that interest rate, the higher return that you're getting, especially looking at something like the S&P 500, where you're roughly about 10% a year. It is going to combine, and it is going to combine about every 7 years, meaning that if you put $100,000 in there, 7 years later, you're at 200,000, 7 years later, you're at 400,000, and then so on and so forth through the compounding aspect. And of course, a majority of these, including the VOO that we talked about, does pay dividends. You do not want to take the dividends out, just like you want to see the exponential growth in there. You also want to see the dividends rolled right back in there because, of course, this is going to turbocharge that compounding interest process that we've talked. It is like, and it's funny because in this article, it's like your money is having babies, those babies are having babies, and then those babies are having babies, and you keep getting more and more as the compounding interest just continues to grow. Now, of course, mixing it up is the last one on here. When you look at don't rely on just one investment vehicle to grow the compounding interest. When you start looking at 401ks, IRAs, stocks, bonds, index funds, if you're looking at HSAs, there's a multitude of ways to do it. But as long as you know that you're investing in something like an index fund, which again, historically, a majority of financial advisors cannot outperform index funds, which again is kind of crazy. And to make all of this work and the compounding magic to work as it is intended, you have to stay the course. The stock market will go up, I promise you. The stock market will go down. The big thing is to stay invested through the rise and the troughs. It is a long-term game. When you think of investing and when you think about truly building wealth, when you think of 40 years of consistent contributions, like we said, $3 to $5 million in that investment account, and that is almost guaranteed. I mean, short of a huge crisis, something kind of crazy, because again, historically, we've seen the stock market returning about 10% with those S&P 500 funds, which means when you're looking over 40 years with regular contributions. And of course, not only are your contributions going to stay at that 10%, but as you get promotions, as you get advancement, as you're working, at a much higher pay scale, that 10% contribution is going to scale with you. Then you throw in the employer match if there is one, and that is an absolute game changer when it comes to the compounding interest. So guys, I hope you really know how to build wealth, and I'll catch you in the next video.